Good afternoon, everyone. Welcome to another one of our Wednesday webinars. Frank's having a little bit of technical difficulties, so we're going to go ahead and get started and see if he could join us once we get rolling. It's an interesting day today. We have a nice strong day in the markets, and I think overall it looks like we've finally found the bottom in the short to intermediate term, and hopefully a bottom for the end of the year. I mean, we only have one more month to go, and hopefully we get a nice little rally in December and maybe not go trade to new highs, but as we discussed last week and the week before, end up at least positive for the year, end up somewhere around the middle of our range for the year and not necessarily at lows and threatening to roll over and crash and start some ugly bear market. So I'd say overall, today's action is pretty upbeat and positive, and I'm happy to see that as a trader. My name is Stock Darts. You can find me on Twitter at Stock Darts. You can find me on YouTube, Stock Darts, and you can find me at patreon.com/Stock Darts. If you're looking for any extra trading content, any more, if you like the ideas that you see on Wednesdays, visit me on patreon.com. There's a lot of good stuff on there. A lot of it is free. Some of it is under paid subscription, but even a lot of the paid stuff goes free after a few days. So if you guys have any interest in that, I think that's a really good spot for you if you like what you see here on these Wednesday webinars. We had some really good trades. We had one on Apple that's working well today. We had one on Amazon last week that worked out incredibly well. And there's a lot of extra content there, and I think it's really worth your time to go in there and dig in. And the cheapest tier is only $8, and pretty much one trade pays for probably several years worth of subscription if you really think about it, and it's really worth your time, not necessarily to just copy the trades, but to see the thought process behind what I do and how I go around looking for trades and how I model trades based off of the environment that we're in. And that's what we're here for, as usual on Wednesdays, is to figure out what the environment is. So let's go ahead and get started and take a look at the S&P 500. We're going to look at the S&P 500, the NASDAQ Composite, the Russell 2000, and the Dow Jones. And once we get through that and analyze where we are in the market, we're going to take a quick look at the US dollar, see how it's faring, see what kind of impact it has on commodities like oil, gold, and silver. And once we're done with that, we'll move on to the chart requests. Those of you that are in here, we have a nice amount of traders in here. If you have a chart that you want me to look at, go ahead and add it into the chat now. Let me know if it's a name that you already own and are looking to stop out or to take profits, or if it's a potential entry and you're trying to figure out where to get in, or maybe it's just a question you have on a pattern and you're not really sure what's going on with that, and it's just for educational purposes and you just want to figure out how that behaves. Anything like that is fine. Just feel free to put it in the chat, and that way I get an idea of how much time we need to allot to the chart requests. But in that, let's go ahead and look at the first chart, which is SPY, which is, of course, the ETF for the S&P 500. And you can see we're up 1.5% today. A nice green candle. Now, one of the key things to pay attention to with today's candle is, you see this white kind of line / box that we have here? That's the opening range for the year, right? We opened up the year with this candle, I believe. I'm going to get bombarded by these ads as usual. All right, let's see. That was January 2nd. All right, so really it was actually the candle below it, right? So this was basically the open for the year. And we're right back above it, right? So that's important because that means that we are actually up on the year instead of negative like we were last week. And this is important for a lot of mutual funds and for, just in general. Our president, obviously, they want the year to be positive. They don't want us to be down on the year. That's kind of a big benchmark, right? To at least finish the year up instead of down. And the fact that we're back above it is a positive sign. And I think today's candle was really strong and indicative of a likely move of continuation at least up to 275 and possibly all the way up to 280. As you can see here, we discussed this possibility last week that there is what looks like a double bottom type of a pattern forming here. I mean, It's not complete. You need to get back above 280 before we really can consider that a bottom. And even then, I think it's so wide that I have difficulty calling it a bottom because, I mean, is it really a bottom when it's engulfing half of the range for the year? But I think the psychology behind it is still valid, which is where we pushed down to a certain level and found some support and then came up and then failed at the same level where we ultimately had failed the first time, and then came down and retested that again. And you'll notice that the second retest also worked, and we found support again around this 262, 263 area. And we are now in the process of making our way up. And again, I think the key here is how we go ahead and behave based off of this second retest. Do we make our way all the way back up to 280 and then try to push past it? Or do we falter here and maybe not even make it all the way up to 280? Maybe we only get back up to the 200 pair moving average, or even just below it. You can see we've got a lot of action over here around 274. And if we go just to 274 and then roll right back over, then we have to really figure out exactly what's going on. There's a couple of different avenues that this could take. And I think overall, it's not necessarily a negative. If, say, for instance, we top out at 275 this time and then come right back down, as long as we bottom out at a higher level than 263, right? And then what we could end up getting is, instead of that potential bottom, maybe we just have a contraction of volatility and range, right? Or we do something like this. And that actually is not necessarily a bad thing either, because in reality, you can't have this kind of volatility last for months on end. Typically, if this kind of volatility continues, it's going to continue to the downside, not the upside. So it's not a bad idea here if we contract in volatility and price action slows down and we trade a little bit more quietly into December. And so that's another potential scenario. And I think that's a good one, right? As long as we can build up some steam. Now, of course, this could end up being one of these things where we trade in the tight range and then open up next year, or even close out this year, rolling right back over and increasing volatility once it dies down. But I think that if we can have the volatility die down here, more likely than not, what it's doing is setting up for an ability to try to push back up and start making its way higher. And at least, again, close the year on a positive note, and then we'll see what happens as we start next year. Now, again, that's just a potential scenario. I think it's a little early to really see what's going to happen. I think judging on how we continue today's move will give us a better clue as to whether we're going to make our way back up to 280 or whether we're going to stall out around 275 and then come back. And the key is, if we do stall out, we want to bottom above 268 to 267. We want to retest this opening range and then make our way back above it. We don't want to head back below and start testing the bottom that we just formed. I think that is where we would have some problems. Now, the other thing, of course, is we can make our way back up to 280. And then the key is, if we make our way back to 280, of course, we need to get above it. But if we can maybe spend a week printing some sort of a flag and then break out, then that bodes really well for us, right? And that would probably mean that we have a new reversal and are ready to maybe not print new highs, but explore the upper half of our range again. And again, the range I'm talking about, if we zoom out a bit and take a look at what we've done this year, you can see pretty clearly that we mostly just traded sideways. Now, we discussed this again last week and the week before, and actually we've quite a bit this year. We've spent the entire year trading sideways, but that's not the whole picture, right? Because in reality, we spent most of the year trading in a very strong rally, right? Let me get rid of some of these trend lines before we continue. You'll notice again, once we bottomed out in April, we actually formed a very nice channel and traded in a very nice rally for 1, 2, 3, 4, 5, 6, 7 months, all the way up to October. And then we rolled over in October, and of course had basically did a mirror image of what we did to start the year, which is these big breakdowns and trying to bottom out in the low 260, 250 area. Now this time we did bottom out a little bit above the lows that we printed in the earlier part of the year. And it shows that at least, again, we have some sort of positive sort of echo here, where there are still bulls that want to get involved, and despite the bearish nature of the price action, there are still plenty of buyers waiting to get back into this, right? When you have a strong rally like this, particularly the second half of that rally, right? If I this part here, right, where a lot of traders are stuck on the sidelines because they didn't get a good entry and they didn't really want to chase the price action, right? And you can see the price action starts to get more narrow, very low volatility as you just sort of climb your way upwards quietly, and that environment is just as difficult sometimes to trade as these really volatile environments to the downside. And the reason for that is that it encourages a different type of bad behavior, which is, of course, chasing and ignoring risk reward, as you get this fear of missing out and a fear of not getting the trades that you want, right? So when you have a situation like that, it lends itself to moving back towards these areas of higher volatility. And in the end, as I said, all we've really done is trade sideways. And it's been actually a tricky year for a lot of traders, despite the fact that we had a nice clear run going up. And it'll be interesting to see how we close it out and what we can really build upon as far as how this action goes into next week and into next month and next year. Now, as I said, I think that today's action is very positive, and I think that there is potential for a continuation, probably to 276 tomorrow or the day after, and then hopefully into Friday and the beginning of next week, all the way up to 280. Now, I think 280 is still a bit of a question mark, because there is that scenario I pointed out earlier where we sort of contract in volatility and the volatility dies down, in which case we might top out here in the 276 area as we hit the 200 pair moving average and the 50 pair moving average, which, as you can see, is turning sharply down to meet price. And if that's the case, again, I don't think that's necessarily a negative, because it likely means that we will just trade sideways and build up a little bit of momentum to start making our way higher. For those of you that are subscribers to our Patreon page, you'll notice that on Monday, when I was looking at trades, I did mention that despite the fact that we still really have a scarcity of nice setups, there were a lot of charts that looked to be bottoming, which is in pretty stark contrast to what I've seen the last month. Throughout the course of, and as if you guys recall, even in September, as we started to get into October, I noticed something different. And again, I want to repeat what I said in my Patreon post. I every Monday, matter of fact, pretty much every day, but particularly Monday, Tuesday, and Wednesday, I go through hundreds of charts every morning looking for trades. Sometimes thousands of charts. And I know it sounds like a lot of charts, and it sounds sort of outlandish to say that someone looks at 1,000 charts, but I do. And granted, for the most part, most of the charts I'm just scanning through, looking really quickly at them, and I spend maybe 2-3 seconds on them. But I go through a lot of names, and when I do that, I get a pretty good picture of what the market is really looking like, right? We don't always get a picture. When we look at the S&P 500, when we look at the Qs, when we look at IWM, we don't always get an exact picture of what's going on in the market, right? But what I noticed in September and heading into October was that the charts didn't look that great. Despite the fact that the market looked great, there were a lot of charts that were breaking down. There was a lot of failed breakouts, and ultimately there was just a lot of failed moves that were heading to the downside and sort of broadcasting that the market was probably going to follow suit pretty soon. And that was one of the things that really led me to say, you know what? October is probably not going to be a good month, and we should really expect and anticipate a sell-off. And we did get that. Now, granted, the sell-off was much stronger than really what I thought. I thought we'd get the first half of that sell-off to about 280. I didn't expect volatility to continue to increase through there, but I knew that we were going to have a lot of selling pressure. And sort of the reverse of that is this week, I finally started seeing signs of stocks that are bottoming out. Now, a lot of them have not completed that process. Very similar to what we're pointing out here in the S&P 500, where it looks like a possible sort of double bottomish type of pattern, but it's only half complete, right? And that's what I notice with a lot of charts is they have a lot of half complete patterns that could be signaling bottoms. I don't think that we are, well, as of today, I think maybe we have conclusively bottomed. But before that, I thought that there was still potential for us to maybe not stabilize. But based off of all the charts that I've watched, I think that we've done a good job of stabilizing here, and probably are ready to bounce into the next couple of weeks. Now, the bounce may not be super strong, but I think that from what I've seen and the charts that I've seen, we should be getting a decent trade environment into the next couple of weeks. Whether that lasts the entire month or not is still up in the air. When you have a market that has taken as much damage as it has over the last couple of months, any sort of whiff of bad news is enough to sort of turn it back sideways or even turn it back down. So I wouldn't say we're totally out of the woods and that we have the safe trade environment that maybe we had this spring and summer. But I do think that at the moment we are in a better trade environment than what we've seen the last 2 or 3 weeks, and certainly over the last couple of months. And so I think that's a real good positive. And I think, again, today's price action is a really good step forward because it sort of proved that we did find the bottom over the last 2 days, and are ready to at least spend time trading sideways and exploring and re-exploring some of these areas that we really were struggling with, particularly this 280 area. I think if we can get back to 280, that's a really good sign that we close the year positively and not at the lows. Now, again, I'm not ready to say that we're going to close the year at the highs. I think that's a pretty unlikely scenario right now. But if we can close around 280, even just a little bit above it, I think that would be a really good win for the bulls. All right, now, if we take a look at the Qs, again, very positive price action. And I think this was, again, broadcast pretty nicely by what I was watching on Amazon last week and even what I was watching on Apple yesterday. It looked to me like we were finally getting to the point where these stocks could get a little bit of relief and start to make their way upwards. Nice move. And again, the white line here is the opening range for the year, and we're right back above it. Now, you'll notice the NASDAQ was weaker, relatively speaking, right? Because the lows that we printed last week were actually below the lows that we printed in October. So there was a lot of selling pressure. And again, a lot of it had to do with Apple and Amazon, Google. A lot of the FANG stocks were really struggling, and they still are. But it looks like they finally have stabilized a bit and are trying to again do what we just said in the markets, which is sort of stabilize, maybe see some of this volatility die down and slowly make our way back up, not to the top, but to the middle of the range, and sort of close off the year in a healthy state and not at the lows and looking like we're about to roll over, right? I think it's pretty clear if you look at the chart. We're struggling today at the 20-pair moving average, but I think you can see there's plenty of space up to about 172 before we get to some more significant resistance. There's also, with the NASDAQ, a little bit of a different view. You got a little bit of a descending trend line here, and it's not quite a channel. If anything, it's a little bit of a broadening wedge, right? But ideally, we'll see sort of one or two scenarios, which are the same ones mimicking what we just pointed out on the S&P 500, which is either we make our way back up towards these previous levels that we broke down from, or we see a contraction in volatility. And I think with the NASDAQ, the more likely scenario looks like a contraction in volatility as we sort of stabilize. Now, I think at the moment, a lot of traders would put this trend line down, but I think that's probably a little too steep to really expect this to sustain this all the way through that other trend line. I think more likely than not what we'll see is we'll trade sideways and then make our way back up, and somewhere in there we'll print out the next pivot point with which we can maybe draw a trend line then and say this is a more likely scenario or trajectory as to how we can make our way back up into the next level of resistance. But for now, we can leave it open-ended, and I think the key is how we close today, and more importantly, how we continue tomorrow. Do we just close this gap immediately? Which again would be par for the course with the volatility that we've seen. But like I said, it's probably about time for volatility to start slowing down a bit. And if that's the case, then rather than us make one big green candle back up to these highs tomorrow, probably what we need to do is maybe inch our way upwards and then trade sideways into the rest of this week, and then maybe open up next week and try to make our way back up. Now, could happen that way or could not. It could be that we just make our way right back up tomorrow. But I think the odds are more in favor of us making our way up to this level here than it is to kind of turn down and test our lows again. I would definitely say we have much higher chance of trading next week into 172 than trading down to 156. Are we going to trade up to 180, 190? Probably not. But I think there's a lot more chances of us trading up to these next levels rather than coming back down and retesting these lower levels. And again, I think the key is, again, if we do sell off into the close of the week, do we stay above 163? If we do, then I think it's just setting up for another move back up towards these higher levels rather than rolling over and testing the lows. And I think that, again, is the most important thing to keep our eye on. Wes, you have actually a few tech names in your chart requests, so we'll definitely get a chance to look at those and see how they're behaving. A few of those are actually doing pretty poorly, but we're going to look at those, Ron, as well as yours. We'll definitely have some time to look at these. Frank, I see you made it in as just Frank iPhone. You can hear me fine. Unfortunately, I guess, yeah, Frank was having trouble today with getting into the webinar. I don't know what was happening with it. It just kept kind of booting him out. But he says the daily charts look the best since the drop from October, and you agree that we could retest higher supports, which would be a good sign. So a lot of times Frank and I see pretty similar things as we go through these charts. Obviously, lately he's been basically just day trading, but that gives him a good finger on the pulse of what the market's doing from day to day. And we will often see very similar things on the market, which of course is not anything, that's not some kind of crazy revelation. Obviously, we're two traders that trade often and have a pretty good gauge of what the market's doing. So we'll see things pretty similar on a lot of cases. And so to sort of continue, that's kind of what I'm seeing on the cues. It's very similar to the S&P 500. I think we have a good chance of making our way higher. And I think today's candle is a very positive development in what we can expect out of the next couple of weeks in the market. And we'll see if we can finish this off, right? Of course, today's candle is nice, but we need to see continuation, and we need to see, more than anything, not necessarily positive action as much as not seeing negative action. I think that's really the important thing right now, is we don't want to lose today's candle in one day and come right back down to 163. We want to print some kind of a bull flag or continue marching higher into the next couple of days. I think that's really the key right now. Now, we move on to the Dow Jones. And again, very similar. Nice big green candle, back above break even on the year. Overall, very positive. And this same sort of idea. Now, again, I don't want to, I hesitate to call this a double bottom. I don't really think that's what it is, because it's not a bottom. Basically, in this particular case, it engulfs half the range, almost more than half the range of the year. But it's the same idea, right? You come down, you test the level 243, come up, come down, test that same level, and the next ultimate move would be to come right back up and test the highs. And the Dow Jones looks like it wants to do that as well. Overall, positive action. Let's get rid of these again. I don't want to, as it is, I think that these lines, I think are it's interesting as we go through the year. Every year, this is something I like to see how it develops. Every Wednesday, I add trend lines, right? So by the end of the year, we have a pretty cluttered chart. And I hope this doesn't confuse you guys or it's too messy for you, but I like to leave the trend lines so we can see them later and see kind of what we watched throughout the whole year. And then at the end of the year, I sort of clear it out and start again the next year. So we got a big mess here, but it gives us an idea of what we've looked at throughout the year and where we are now. And so a couple takeaways from the Dow Jones that are a little bit different from the other charts. And one of them is we are very firmly now below this green trend line, and I think that's pretty important because the Dow Jones was the last major ETF to actually lose the trend that we had over the last couple of years. You can see we had a very nice and strong trend of the Dow Jones, and because of the incredible relative strength that we had to close out last year, even when it started trading sideways, it had plenty of room to retrace to still stay with this uptrend intact. And only recently have we finally lost it. And I think that was the final sort of nail in the coffin to say, yes, this is going to be a sideways year rather than a continuation of last year, and that we just continue to climb into new highs as we close out the year. So that's kind of a key thing here, and an important level now that could come back and have some extra ramifications as we close out this year, right? When we come back, and if we come back and test this level, we should, do we roll over again, or do we start trying to make our way back into that channel and make our way higher? Again, the Dow Jones has had the most lingering bullishness of any of the indices when it comes to respecting that trend line, and it'll be interesting to see what happens the next time we meet it. Now, for now, that's not really what I'm looking at. As you can see, there are a couple of different trend lines that you can look at that both hint at price action slowing down, right? Most people wouldn't bother with this sort of intermediate trend line in the middle of the price action, but I think it gives you a good picture of what the Dow Jones is trying to do if you ignore the big gap up and immediate failure when it tried to really just say, nah, we're still rallying, don't worry about this. This was one of those situations where the Dow Jones is like, oh, don't worry, guys, I got this. We'll pull ourselves out of this correction, and ultimately it didn't work out. But either way, I think it shows a slowing down of price action. Obviously, after this huge correction, you're going to see that. But what we do have is, hopefully, again, a quiet period in the stock market. And this was, again, something we discussed last week, and a concept that I teach a lot when I work with traders, and particularly when we're looking at technical analysis and understanding cycles in price. And that is that typically the way price action works is you have an action and you have a reaction, right? And you can look at any chart, and depending on what time frame you're looking at, you can identify action points and reaction points, right? And of course, you can look at it as different ways. You can look at it as consolidation ranges and then breakouts and breakdowns. And you'll see that there's a lot of those types of moves, right? And what we have right now is sort of the reaction to the breakdown that we had in October. And that reaction has taken a pretty wide and volatile space as it sort of chops back and forth. And I think we're at the point now where we need to conclude this reaction, right? And the way we do that is by tightening up the volatility and setting up for the next action. And the next action could be a further breakdown, or it could be a move back up and sort of a confirmation of this being ultimately support and us making our way back up to highs. Now, are we ready for that? No. I think if you just look at the chart, you can see this doesn't really give us a pattern that you could say is nearing completion. This looks like volatility that is still trying to unwind, and at the moment isn't really unwinding, right? If you look at today's candle, you look at yesterday's candle, we still have pretty wide candles, right? So this volatility has yet to really unwind and has yet really to sort of slow down to tell us that traders are reaching agreement on price. And ultimately, that's what all these candles tell us, right? It's when they're big and wide, traders disagree. And when they're very small and narrow, when the range is narrow, traders agree on price, right? And at the moment, traders still have pretty wide disagreements on where price should be. And what we need to see now is we need to see the range narrow so that we can get a buildup where you get an imbalance building up, where there will either be buyers that ultimately will overwhelm the sellers or vice versa. And that's when you get the nice trends and the nice breakouts or breakdowns in whatever direction you want, right? And we're not seeing that yet, right? And I think that's one of the key things we can point out or pull out of this analysis of the Dow Jones and even of the last two is that we're still in the process of trying to unwind this volatility and trying to finish this reactionary phase. And I don't think we're there yet. But like I said, I think the important thing to point out is with the bottom that we experienced the last couple of days, I think we can say that at least we are reacting to this rather than a continuation of the previous action, right? There was a point there where it looks like, because sometimes you can't really tell if it's the beginning of a major reactionary phase or just a small pause before the action continues, right? So we had the breakdown, and then we had this sort of big volatile mess, and the last few days we were not sure. Are we ready to continue the down move, or are we already in the process of consolidating? I think with today's action, it's pretty clear that we are likely consolidating, and at the very least, this breakdown and this correction from October has concluded, and we're now in the process of trying to figure out how we want to stabilize and set up for the next move as we probably close out this year, and the next key move probably will be at the turn of the year or the beginning of next year. Or at least that's what it looks like right now. Now, the last one we want to look at is IWM, which of course is the small caps, and you'll notice one huge difference, obviously, right off the bat. We are still we're not break even on the year here, right? We're still down on the year with IWM. This idea of a potential double bottom, not really in the cards yet. We have the same sort of idea or same sort of pattern here, where what we can really hope for at the moment is a stabilization of price and a contraction of volatility, right? That's what we really need to hope for right now. To come up, test 150, stabilize, try to make our way back above it, and again, try to finish the year on this side of this pattern, right? Above 156 to 160. If we can finish the year there, that's great. But we're not there, and we're not anywhere close to that right now. And I think so. This is another chart that we need to look at. And if ultimately this proves to not be a bottom, IWM will be the first to tell us, and it'll make new lows. And that'll be the easiest way to look at it. And so right now, that's probably what we want to watch with IWM is not necessarily that it can get back above these levels, but we don't want to see IWM make new lows, because if it makes new lows, it will be the first one, and it will likely tell us what the rest of the indices are going to do. So that's probably the most important thing to watch with IWM. Now, hopefully, what we can see here is over the next few days, we come up and test 154 and try to build up some steam to get back above it. If we can get above 154, we probably get above this trend line and at least maybe the 50 period, and then hopefully just, again, close out the year somewhere in this area. Now, we've got a whole month, right? So there's a lot of price action. There's a lot of trading to be had, and there's a lot that can happen from here to there. But over the next couple of weeks, what I'd like to see is, again, for us to not be below 145 and to be somewhere in this area and making our way back above it. Could happen tomorrow, could happen next week, maybe it doesn't even happen, but that is what we are looking at. Now, I do want to point out, traders are still pretty cautious, right? There was a point last week where there was life coming into the small caps before other stocks, and it showed that traders were willing to take risks. That has not completely played out that way this week. As you can see, now we are up nicely again. We're up the same percentage today as most of the other indices, right? All of them were up somewhere between 1% and 2%. So it's not like they're lagging today. It's not like they're really lagging this week. But overall, for the year, you can still consider them as laggards, right? And I think ultimately this shows that traders are still sticking to some of the safer names, right? If we go back and take a look at all four of the indices again, you'll see the Dow Jones is doing nicely above for the year. The Qs are up nicely. And the S&P 500 also up. When I say nicely, I mean they're at least far enough away from these. Obviously, we didn't expect to close this year this close to break even. But all three of them are healthy and at least above that and making their way back up to their 200-period moving averages, while IWM is still very, very far away from these levels, right? So the next thing we want to see is for traders to start taking risks, but I think that's still a bit away, right? So I think for now, the biggest thing is let's see if we don't necessarily need positive action. We just don't want negative action. And I think if there is going to be negative action, the first place we're going to see it is IWM. So it'll be a good idea to sort of watch the small caps and see what they do from here to there. All right, that covers the four major markets. I know we spent a little bit of extra time on it, but again, I feel like these are important inflection points in the market where we need to really get a good sense of it. We won't spend that much time with the dollar. I think we're getting a nice reversal today. We actually had a huge run up. We were actually printing even early, just an hour ago. The U.S. dollar is doing much better than it is right now. But overall, it's doing very well, right? We're obviously near highs. If you take a look at all the individual currency crosses, they're doing very good. When you look at the U.S. versus the Canadian, it was at the top of the channel. It just kind of reversed. And I think we're at a point here where the U.S. dollar is ready to pull back a bit. As you can see, I mean, this all just happened right now. We go to a 15-minute chart. You can see this is all happening as we speak. And it doesn't catch you by surprise. It might even be some of the comments we had earlier from the chairman of the Fed. But, excuse me, ultimately it was part of the plan, right? You look at this channel that we've drawn, and we've pointed this out over the last few weeks, and each time it gets to the bottom, it goes to the top, and then when it gets to the top, it goes to the bottom. Overall, the U.S. dollar was due for pullback, and it looks like we are getting that pullback as we speak. Versus the yen, same thing. Start to see the beginning of a red candle. Now, the yen is trading in a little bit of a different pattern. You can see the contraction and volatility on this. And this could be setting up for a nice broader term trade that could set up in the next month or so. And then finally, the last one we want to look at is the euro. And the euro should be gaining plenty of traction here. And again, that was after it lost quite a bit over the last week. It's still in the process of trying to find a bottom here. And this looks like this move can extend for another few days and get back to about 114. And then from there, I think that's the real key level, is what happens when we get to that. Does the U.S. dollar again turn around and surge higher? Or do we finally get a breakdown where the U.S. dollar can pause and come back down more and let some of these other commodities and crosses work in their favor, and you know, the U.S. dollar slows down? I think that's still up, not really to be determined, but the key level will be what happens with the euro as we get to 114, 115. I think that'll tell us a lot more about the others. Now, we look at gold and silver, and as you can imagine, again, if we point out, if we go to a 50-minute chart, this all happened right now, right? With the U.S. dollar starting to go down, all of these are going up. And this is a nice bullish turn of events for GLD. In particular, that's a very nice candle. If you were just looking at this in a vacuum, this looks like a candle to buy, right? Because you had a nice move up to get above 115. Then we have this pretty orderly correction, and then we have a false breakdown that's occurring right now where it looked like we rolled over and got back below 115 yesterday, but then today's strong action to get back above this level, this actually looks like a nice buying point for GLD and for gold in general, for gold miners and anything along that nature, assuming this holds. And again, I'm not sure exactly what the news is, if this is still ramifications from the Fed comments earlier or something else, but it looks like the U.S. dollar is starting to lose a little bit of traction, and this probably is a move that will last the next few days at the very least, and maybe even the next week or two, which means that GLD should do decently. Now, SLV has been pretty weak, and I think if you want to trade precious metals, you're probably better off focusing on gold rather than silver, because again, there's so much more room for silver to make up, but it's relatively speaking so weak that it will probably not move as strongly as gold. So if you wanted to take a precious metals trade, I think I'd focus on gold over silver. And then the last commodity is oil, and oil actually really struggled. And last week, I pointed out that it looked like we probably were going to bottom out based off more than the pattern, based off of the level we were at. That didn't really happen. And I think at this point, we still want to see that. I still think it happens, and I think this is part of a continuation of the breakdown that will ultimately prove to be a bottoming point. But at this point, I think it's better to wait and see what happens. We need to see it get back above 53 to 54. And then from there, I think it'll set up for a nice bottoming trade. We looked at a couple oil names last week, and I imagine they're not doing that well right now. But I mean, that's why we wait for reversal patterns before we go ahead and take trades. And you don't just buy levels, right? Because sometimes we'll crash through a level and test it several times before it's really ready to move past it. And that looks like that might be the case with oil. So for the moment, we need to wait on oil names to see if price action can stabilize and give us better patterns. Okay. All right. So that's it for oil, gold, and silver. Again, I didn't spend a lot of time with it, but as you can see, there's a lot happening right now with the U.S. dollar. And so there may be some precious metal trades that we could look at and investigate a little bit more into the coming days, depending on what the market does. And maybe that's a better place to go ahead and take a look at stuff. Let's move on to the chart requests. Ron, you want to look at coals? And you have coals and target. You have December calls that are green. Are they likely to fill their gaps? All right, in coal's case, I think there's a very good chance it fills this gap. And I mean this gap, and not this gap. I think there's a very good chance it fills this gap. That's clearly what it wants to do. Now, we do have a rising wedge. I've been tracking this pattern quite a bit over the course of the last few weeks, looking at a lot of potential short trades that are forming patterns like this. And I've noticed that a lot of charts have been able to push through this. I want to point out, because this is a pattern that we've looked at a lot, right? You'll notice this pattern across the board. You'll have a lot of these, right? This was one. Right, a lot of these patterns where you have these rising wedges, and sometimes they actually turn into bullish plays. They don't always end up bearish, right? And it's what I'm seeing here on coals. Now this could play two ways, right? It could end up like Gentex, and you ultimately push past that key level and make your way back up into this area, or this could be setting up as a short play where once it hits 70, it rolls over, right? So I would definitely be looking at taking profits, at least partial, if not total profits, at the gap. But I think that there's a very good chance that it gets there. I think, again, the pattern that I've been playing out and watching that rising wedge pattern, I've seen it across the board. That's one of the most common patterns in the market right now. And more often than not, they get back to that level. And then from there it depends. Sometimes they roll over, sometimes they don't. I think right now there's a few of them that are not rolling over because the market's doing well. But last week, a lot of them did roll over because the market was not doing well, right? So a lot of it, of course, depends on what the market does. But I have seen this sort of pattern play out quite a bit. And more often than not, they do get back to that previous level. And then from there, I think it depends on what the market's doing, on whether they roll over or not. So this is one of those where, there's two sides to the coin, right? And there's two sides to the trade. And this could be a short trade that's setting up, or it could be a long trade that's culminating. But either way, I think ultimately the decision and the inflection point where it figures out what it wants to do next is that gap. So, yeah, if I were in your trade, I'd be waiting for the gap as well. I think it probably gets there. Target, on the other hand, that's a big gap. I don't know that it gets to that gap in time for you. You have December calls. I imagine you have the monthlies, right? So you have probably up to the 21st. This probably doesn't get there by the 21st. I could be wrong. My suspicion is that this probably gets, if you can get half of this move, you probably want to take it while you still have value in your calls. This is a much this is a much bigger move that you need, and at the moment we're struggling here, and this could end up setting up an island before it's really ready. This was a pretty big gap down. Now, when does theta decay start to kill you on target? Well, it accelerates as you get closer and closer to that as you get closer to expiration. But I think that ultimately, by the end of next week, you'll really start to see it start to really increase, and you'll start to, if this thing is still, I don't know, a lot depends, of course, how far out of the money you are as well, right? But I'm assuming you have something like 75, 76 calls. I could be wrong, but I'm just guessing. And if this thing is still trading at 71 by the end of next week, you're going to see you have 70. Oh, then if you're in the money, you're not going to see the time decay quite as much, because as it is, a lot of your value is probably tied to intrinsic value already anyway. You're still going to see the value drop pretty quickly. Any of the extra value that you have, you're going to start losing it. But that value you lose that value a lot faster out of the money than in the money. So I would say by the end of next week, you probably have a decision to make as to whether you want to hold it longer, or what you could do is you can maybe sell a 74 or 75 call and then protect yourself by having that premium disappear and offset the premium you're losing on the calls that you bought, right? But yeah, this one to me looks like what I'm seeing here. And I think, again, tomorrow's price action will say a lot. If the markets just ramp up and we get another strong day tomorrow, then what you're going to see is this, right? And that's going to be a big move for you, and that's going to give you a lot of that'll give you a huge amount of profit based off of the trade that you're taking. But if the markets stall out and you end up spending the rest of this week like this, or even like this, right? Let's say you spend the next couple of weeks like this, then it's gonna be kind of a dampener on that trade for you, right? Because then the ultimate move you can expect again is probably something into 74, 75. But I think in either case, whether it consolidates here or up there, I think that you're going to look at the same sort of scenario, which is it's going to spend the week trading sideways, either at 74 or down here at 69. And then maybe, I mean, again, I don't want to say that it can't get here. 3 weeks is a long time. A lot can happen in 3 weeks. But my suspicion is that this will make half the move and then stall out before it tries to make the full move. It could make the full move by the end of the week, or by the end of the month. But my suspicion is that this thing needs more work to do, rather than Coles, which is, it looks like, Coles could fill the gap tomorrow. So hope that helps. I don't want to say that it won't fill the gap, but I think that this is more likely than not. It'll probably get halfway before you really need to make a decision on your calls. Now, again, because you're in the money, you're in a little bit of a more safe position than someone that was out of the money. Those out of the money calls lose value really fast as you get to expiration. You'll lose the value on yours as well, but you're in the money, so at least you have the intrinsic value and you have a long play. You still have the directional delta profits that should work in your favor, obviously, because you're in the money. Okay. Wes, let's take a look at Activision. We'll look at Activision, Twitter, and MU. So Activision has been a disaster. I'm pretty surprised by how poorly they've done since the launch of Call of Duty. For everything I've seen, the game has done pretty well. That being said, it has turned off a lot of people with their microtransaction system, and I think it's been ultimately a failure as far as getting extra sales from their microtransactions. And I don't know if that's what's causing this big drop, but I do know that it has behaved very, very poorly since the launch of that game, and it's been really struggling. Now, that being said, we have an interesting pattern over the last 3 days, right? And what could be a possible bottom, we go down to the weekly chart, and you can see that we're not at a major level, horizontally speaking, right? We go all the way down, and I'm pretty sure that's going to be, yeah. We're a long ways away from any real strong technical levels, but I think that this is a key level. And the reason I say that is we had this nice sort of cup and handle, right? And after that, we had this really tight consolidation range and this nice little base before we really took off, right? And that's where we are right now. Now, one thing I want to point out is we have a range here that we have not fully explored the bottom of, right? Which is the $50 to $45 range. But 50, very key number, nice big round number, and it may feel like a coincidence, but remember, these charts are a reflection of traders' attitudes. Every time that you look at a chart, you have to understand that you're not looking at Activision. What you're looking at is what traders think Activision is worth. And a lot of times, traders, which of course are humans, they gravitate to these round numbers, and these round numbers become important. And so right now, we have a situation where traders told themselves, you know what, man, this thing, it's not an $80 stock anymore. But at the moment, they still think it's a $50 stock. And I think that's what we're seeing here is we had this big slice through. We came up, we've had this really tight consolidation. And if we really zoom in, you can see we've had three very nice little wicks here where buyers are stepping in and saying and buying at $50, saying this is a good price for the stock, right? So if you're looking for an entry, I think we have an entry right now. And the reason I say that is we have this and we have this, right? And what I'm going to do here is I'm going to zoom into, say, a 30-minute chart, see if we can get that whole pattern. Right, so here is the potential bottom, right? And as you can see by the descending trend line, we have successfully stabilized, right? Now the next step is this one. And let's change this to a dotted line. The next step is, are we ready to break this level here, this 51? And depending on your level of aggression as a buyer, you can say, well, screw it. We already broke past the $50 range and we broke past this descending trend line. I want to enter right here. But if you want to be more cautious and say, well, I want to make sure that we're ready to move, then you'd want to wait for us to, and what we're doing right now, basically, which is get above 51. And then once we get above 51, well, then we can maybe anticipate a move to 53 and then ultimately 56. And then who knows, even the gap fill all the way to 62. That's a lot when you look at it on the daily chart, right? But I think ultimately this is setting up for a play right now. And it could ultimately fail, right? The weakness that we've seen, this could roll right back over. But this looks like a nice, this looks like a long setup right here. This is what you want to see. When you find a key level, we were talking about that earlier with oil, right? Where you don't want to just buy a level. You want to find confirmation. You want to get a pattern at that level. And I think at the moment we have a pattern at that level that is very close to resolving, at which case you could buy the long play. Is there a guarantee it gets to 56 and to 62? No, but it's more likely than not to, at the very least, establish this as a bottom and range between the mid-50s and 50 for the next couple of weeks. And if you're lucky, you get a quick move up to those prices. But if not, it should begin to climb its way once it gets past this level. So I think that this is actually at a spot right now where you can really, really watch it. And it's very close to a complete entry for even a cautious trader. Twitter. All right. So with Twitter, we have There's a couple of ways of drawing this. I think I'm just going to draw a horizontal line. All right. Twitter is, I think it's close to a potential long play, but I think it's also close to a potential short play. It needs to. So we have two converging opinions, right? And remember, a trend line is a picture of trader sentiment, right? That's another thing. I'm not just connecting dots on a chart. This tells you what the prevailing sentiment is in the short term, in the intermediate term, and the long term, right? In the intermediate term, Twitter has bottomed, right? Traders think that it's going up. In the short term, traders think Twitter has reached the price that it's not worth, which is this $36 level, right? And you have a conflict coming between these two prevailing thoughts or opinions. And it's going to resolve in one direction or the other. And when it does, that should tell you what you want to do with it. And that's what I do with this one. I'd wait to see the resolution here. If it resolves to the upside, this is the key level, basically. And you can see it goes all the way back to here, really. But we're not going to keep it all the way over there. Right? That's a pretty important level. That was where we first tried to make our way up, and then ultimately failed, and then came back up, and then it was resistance level, and it's a resistance level right now. You can get above 33, get above this red trend line, and we're in good shape here, and that would be a good sign that it's ready to break out. And then the 200 period moving average will probably be an afterthought as it makes its way back up to 35. But I think this one is not quite as ready to go as Activision. I think that we need to see how this resolves between these two kind of opinions on it, and then from there you'll get a much clearer picture. But this one maybe needs a few more days at the least to see what wins out between these two trend lines, and then from there you get a better idea. But again, even if it breaks out, I think it only has upside to 35, 36 before I'd be worried about it. There's a big gap to fill here, but I think if it does move up to this level, it might stall out here and wait longer before it goes up. So between this and Activision, I certainly prefer Activision. Even though Activision is a lot worse, what it's done over the last month, it has more room for growth here than this one. I think this one, even if we get the break of this red trend line, we're still going to have to see what it does here, right? And it could break it. It could ultimately break past that level, but I think it just makes for a messier trade where you need to then take partial profits here or do something while you wait for it to break out of this much larger pattern, right? You could almost see like a cup and handle forming, and it might need more time to really get past 35. But I think in the short term, what we want to see is a break of this red trend line, and from there that means it's going to come up to 35, but then what happens at 35 is really anyone's guess. And then finally, you have MU. And I looked at some semiconductors a couple of weeks ago, and they look like they could be setting up for a bottom. MU did not, and MU has not. It's not breaking down, really. And so, I mean, it's at a decent level here. Not quite where it needs to be yet, but close. Right? You can see what I'm looking at. Now, we do have a pretty clear trend line, right? We'll go back to the daily on that. And I mean, ultimately, it's something like this, right? I mean, that trend line, even though it's been broken a few times, is ultimately a good representation of what MU is doing, right? You can see it's tried to break it a few times and failed. And I think it still needs work. I think obviously it needs to break this trend line, but I would say ultimately I think it even needs to get above the 50. So what I'd do is these are the levels I'd watch right now. And actually, you could even say, actually, I'm going to say this. This is what I want to see. All right, bam. We've got, so now this is a double bottom that a lot of traders will say, oh, we got a double bottom. This is not a double bottom yet. This is a potential double bottom that is not complete until you get this. Okay? And so if you want to trade MU, there are two ways of trading it. One is you wait for it to break 40 and come back and retest this 40.70. And then from there, you have a really high probability entry. The other one is, if you want to be more aggressive, is, well, super aggressive you would have bought yesterday, but I think that's not a good play. What you do is you wait for it to get to this level, and then what you want is you want for it to consolidate and trade sideways for a few days, and then as it breaks above 40.70, then you go ahead and play to the long side. Now, risk reward it's a little sketchy depending on what you would consider your stop. If you're going to stop out at 34, then it's a terrible play. But if you decide that you'll take it and hold long as it stays above this 40.70 to 40.50 area, then you do have good risk reward, and you can look for a nice slow move up to 45 and 50. And that would be a really nice bottoming pattern that is setting up, but I don't think is quite there yet. Okay? But again, I think that illustrates the point I was making earlier, which is you want to find a good level, and then you want to find a good pattern. And that is a pattern that's developing. But I would put this on my watch list, and I'd wait for this pattern to fully resolve. To me, this is one that this is a chart that looks like it's ready to go on a watch list, but isn't ready to trade. That's how I'd work with that one. Okay. All right, guys. So that's it for today. I hope that we had some good constructive analysis of charts today. Hope you guys enjoyed it. Again, if you like this content, if you want to see more of it, feel free to go to my Patreon page. And again, a lot of free content, a lot of pretty cheap content, and a lot of good stuff. And you get a lot of extra chart reads based off of it. And it could you never know what it leads to. Even just a little discussion on those rising wedges could end up having you go around looking and doing a screen and finding other ones that work good for you. So hope that helped you. Other than that, hope you guys have a good rest of today, and we'll see each other again next Wednesday.